Before we dive in, a quick but important disclaimer. I am not a licensed financial advisor or insurance agent. The information provided in this video is for educational and informational purposes only and does not constitute financial or legal advice. Insurance policies are complex contracts, and your individual needs will vary. Always consult with a qualified and licensed professional before making any insurance decisions. This presentation is intended to provide a general overview and should not be used as a substitute for professional guidance. Okay, let's get right into it. Your brother is flying in from across the country for a week. He wants to borrow your car to run some errands and visit a few old friends, and your stomach just drops. You love the guy, but a million nightmare scenarios start flashing through your mind. What if he gets into an accident? Even a minor fender bender? Whose insurance covers it? Is it yours? Does he have his own? Will your rates skyrocket for the next 5 years because of something he did? Could your insurance company drop you entirely? It's a simple, friendly request that suddenly feels like a high-stakes gamble with your financial future. You're caught between being a good sibling and protecting yourself from a potential catastrophe. Or how about this one? You finally found the perfect used car on Facebook Marketplace. The price is right, the mileage is low, and it's exactly what you've been looking for. The seller is a private individual, and he hands you the keys and the title. You're ecstatic. But then it hits you. How do you legally drive this car home? You can't add it to your policy until you officially own it, but you can't legally drive it off the seller's property without proof of insurance. You're stuck in a classic chicken and egg problem, standing on a stranger's driveway, holding a set of keys to a car you can't move. These situations and a dozen others like them are incredibly common. Yet most Americans have no idea there's a specific, simple, and often surprisingly affordable solution designed for exactly these moments. We're going to pull back the curtain on one of the best-kept secrets of the insurance industry: temporary car insurance, and specifically, the 7-day policy. By the end of this video, you're not just going to know about 7-day car insurance. You are going to be an expert. You will understand precisely what it is, who it's for, and the exact situations where it can save you from massive headaches and potentially thousands of dollars in fines or damages. We'll cover how to get it, which major companies secretly offer it, what you can expect to pay, and most importantly, the critical mistakes and misunderstandings you absolutely must avoid. This is the definitive guide you've been looking for. Now, the first thing I hear when I bring this up is, wait a minute, my personal auto insurance policy has something called permissive use. It means anyone I give permission to drive my car is automatically covered. And on the surface, that sounds right. Many standard policies do have a permissive use clause, but relying on it is like playing Russian roulette with your finances. It is one of the most dangerous assumptions you can make. Here's why. First, permissive use is designed for infrequent, occasional use. It's for when your friend drives you home from a party because you had a drink. It is not designed for your cousin to use your car as his personal vehicle for a full week while he's in town. Insurance companies can and will argue that a week of daily driving is not occasional use, potentially denying the claim and leaving you on the hook for everything. Second, even if the claim is covered, it goes on your insurance record. That accident your brother got into? That's now your accident in the eyes of your provider. That means your premiums are the ones that are going to spike at your next renewal. You'll be paying for his mistake for years to come. And third, and this is the big one, when someone borrows your car, they are typically only covered up to the limits of your policy. Let's say you have the state minimum liability coverage to keep your costs down, maybe $25,000 for bodily injury. If your brother causes a serious accident and the medical bills for the other driver are $100,000, where do you think that extra $75,000 comes from? Comes from you. They can go after your savings, your assets, even put a lien on your house. Your simple act of kindness in loaning out your car could lead to your financial ruin. This is the exact gap that 7-day car insurance is built to fill. It's a standalone, separate policy. It's a shield. It creates a firewall between a temporary situation and your long-term financial health. Think of it not as car insurance, but as relationship insurance or peace of mind insurance. So what is it exactly? A 7-day auto policy is a short-term, standalone insurance contract that provides coverage for a specific vehicle for a limited period, typically 1 week. It's a legitimate, real policy that provides you with an official insurance card, the same kind of proof of insurance you have for your annual policy. You can show it to law enforcement if you're pulled over, and you can present it at the DMV. It is not a gimmick. It is a specialized financial tool. The beauty of it is its surgical precision. You're not signing up for a long-term contract with cancellation fees. You're not adding a temporary driver to your main policy and hoping for the best. You are buying exactly the amount of coverage you need for exactly the amount of time you need it. No more, no less. Let's get crystal clear on who this is for. The applications are broader than you might think. It's obviously for our first scenario, letting a visiting friend or family member borrow your car. You buy a 7-day policy in their name for your car. If anything happens, their temporary policy is the primary one. Your personal insurance is protected, your rates are safe, and your relationship with your family member isn't destroyed over a car accident. It's the perfect solution for buying a car from a private seller. Before you even leave your house, you can go online, enter the vehicle identification number, the VIN, of the car you intend to buy, and purchase a 7-day policy. You can have proof of insurance emailed to you in minutes. You show up, finalize the deal, and you can legally and safely drive your new car home, completely stress-free. This gives you a full week to shop around for the best annual policy without being rushed into a bad decision on the spot. It's a lifesaver for college students who come home for spring break or the holidays. They might be listed on their parents' policy as a driver, but often only at their parents' address. If they're driving a family car for a week straight, a temporary policy can provide clearer, more robust coverage and protect the parent's primary policy from a youthful mistake. What about if you need to drive a car that isn't yours for a road trip? Maybe you and a buddy are swapping driving duties on a cross-country trip in his car. Instead of just hoping his permissive use clause is good enough, you could get your own 7-day policy for his car, ensuring you are fully covered under a policy with your name on it. It's also essential for people in what's called a drive-away situation, transporting a vehicle from one location to another for someone else. Maybe you're helping your grandparents move and driving their car to their new home in Florida. A 7-day policy is the professional way to handle that responsibility. Even for international visitors with an international driving permit, a temporary U.S. policy is a game changer. It ensures they meet state insurance requirements and aren't a massive liability for the person whose car they might be borrowing. The core principle is this: anytime you are driving a car you don't own, or someone else is driving a car you do own for more than a single brief trip, you are entering a gray area of insurance liability. A 7-day policy erases that gray area. It draws a bright, clear line. It says, for these 7 days for this specific driver in this specific car, this is the policy that takes the hit if something goes wrong. It isolates the risk, protecting everyone involved. It turns a stressful, ambiguous situation into a simple, straightforward business transaction. And that is incredibly powerful. So who wields this power? Who are the people walking out of a private car sale or borrowing their brother-in-law's pickup truck, armed with this specific temporary shield of financial protection? The answer isn't just one type of person. It's a whole spectrum of everyday Americans caught in very specific, very common situations. Let's start with the most classic example, the car buyer. Imagine you've spent weeks scrolling through listings, dealing with flaky sellers, and you finally find it. The perfect used car. It's a private sale, just you and a guy named Dave in his driveway. You've agreed on a price. You hand over the cash, he hands you the keys and the title. Now what? You have to get this car home. But it's not insured. You can't legally add it to your existing policy until the title is in your name, which could take days or even weeks at the DMV. You certainly can't drive it uninsured. That's a massive legal and financial risk. One fender bender on the way home, and your great deal just turned into a nightmare that could cost you tens of thousands of dollars and a suspended license. This is the gap. The terrifying limbo between ownership and administration. 7-day insurance is the bridge over that gap. Before you even hand over the cash, you can go online, enter the car's VIN, and get a temporary policy that starts immediately. You print out the proof of insurance, put it in the glove box, and you can legally and confidently drive your new car off Dave's driveway. It gives you a 7-day buffer, a full week to get to the DMV, get the title and registration sorted, and then at your leisure, shop around for the best possible annual insurance policy without being rushed into a bad decision. You're not just buying insurance, you're buying time, peace of mind, and the freedom to handle the logistics properly. Now let's look at another incredibly common scenario. The borrower. Your friend is moving apartments this weekend and you, being a good friend, offer to help. The only problem is, your compact sedan isn't going to cut it. But your buddy Mike has a big pickup truck he's not using. He's happy to let you borrow it. But here comes the awkward part. "What about insurance?" Mike says, "Don't worry, I've got full coverage, you're covered." But are you really? This is where things get murky. It's called permissive use. And while most policies have it, it's often limited. More importantly, if you get into an accident, it's his insurance that takes the hit. It's his premium that's going to skyrocket for the next 3 to 5 years. You've just turned your good deed into a massive financial and social burden for your friend. It's the kind of thing that can strain a friendship to its breaking point. A 7-day policy completely changes this dynamic. Instead of relying on vague promises and risking your friend's financial future, you take ownership of the risk. For a small fee, you purchase a policy in your name for that specific truck for the exact days you'll be using it. Now, if the unthinkable happens while you're hauling a couch across town, your temporary policy is the primary one. Pays out first. Mike's insurance is completely untouched. His driving record remains clean. You've transformed a favor from a risky liability into a clean, responsible transaction. You're not just borrowing a truck. You're borrowing it like a professional, with all your bases covered. Let's zoom out a bit. Think about the visitor. Your cousin from Germany, let's call her Anya, is coming to visit for a month. She wants to explore, to take a road trip up the coast. Renting a car for that long is astronomically expensive. But you have a second car that mostly just sits in the garage. It's the perfect solution. But her German auto insurance is completely invalid here in the United States. Adding her to your policy as a foreign driver can be a bureaucratic nightmare, if your insurance company even allows it. Some companies flat out refuse to cover drivers without a US license. This is a perfect use case for short-term insurance. Anya can purchase a 7-day policy to get started. It allows her to drive your car legally the moment she arrives. If she decides to extend her road trip, she can simply purchase another policy for the next week. It's flexible, it's immediate, and it bypasses the red tape of trying to add an international driver to a domestic annual policy. It empowers your visitor with freedom and protects you, the car owner, from any potential liability. You're not just lending a car. You're providing a key to the country without taking on any of the risk yourself. Then there's the person I call the in-betweener. Life is messy. Sometimes policies lapse. Maybe you missed a payment and your coverage was canceled. But you have a critical job interview tomorrow morning across town and you have to drive. You don't have time to research and commit to a new year-long policy right this second. A 7-day policy is your lifeline. It gets you back on the road legally in minutes, giving you the breathing room to find a long-term solution without derailing your life. Or maybe your primary car is in the shop for a major repair that's going to take 10 days. The dealership gives you a loaner car. Many people assume their personal auto insurance automatically covers the loaner. Often it does, but the coverage levels can be different, or there might be weird exclusions. A temporary policy on that loaner car provides unambiguous primary coverage. There are no gray areas. You know for a fact that you are fully protected while your car is being fixed. It's gap coverage for the unexpected gaps in life. Finally, let's consider a more passionate niche case, the enthusiast. Picture a guy who owns a pristine 1969 Chevrolet Camaro. It's his baby. He keeps it under a cover in his garage 360 days a year. He only drives it to a handful of car shows in the summer. Does it make sense for him to pay for a full 12-month insurance policy with all the bells and whistles? Absolutely not. He'd be paying for hundreds of days of coverage he will never ever use. For him, 7-day insurance is a scalpel, not a sledgehammer. The weekend of the big Pistons and Polish car show, he goes online, gets a 1-week policy, and enjoys his hobby. The moment the weekend is over, the policy expires. He's not paying a dime to insure a car that's just sitting in the garage. It's the ultimate pay-as-you-go model, perfectly tailored to a specific lifestyle. So from the first-time car buyer to the weekend warrior, from the visiting relative to the classic car collector, the thread that connects them all is the need for a temporary specific solution. It's about having the right tool for the job. You wouldn't use a hammer to turn a screw. So why would you buy a 365-day insurance policy when you only need coverage for 7? It's clear who this is for, and why it's so incredibly useful. But that raises an even bigger, more pressing question. If this type of insurance is so logical and solves so many common problems, why isn't it everywhere? Why don't you see ads for it during the Super Bowl? Why do you have to actively seek it out? The answer to that question pulls back the curtain on the multi-trillion-dollar insurance industry and reveals a truth they probably prefer you didn't know. And that truth is remarkably simple. For the giant legacy insurance companies, you, the short-term customer, are a terrible business proposition. It's not personal. It's just math. To understand why 7-day insurance lives in the shadows, you first have to understand the fundamental business model of a company like State Farm, Allstate, or Progressive. We think of them as companies that sell protection, but that's only half the story. In reality, they are colossal investment firms that happen to use insurance policies as their primary way to gather capital. Here's how it works. You and millions of other people pay your premiums every month for your 6-month or 1-year policy. This money doesn't just sit in a digital vault waiting for you to have an accident. No, that would be a colossal waste. Instead, all those premiums form a gigantic pool of cash called the float. This is one of the most brilliant and powerful concepts in finance, famously mastered by Warren Buffett with his company Berkshire Hathaway, which owns Geico. The float is essentially a massive, interest-free loan from all of us, the policyholders, to the insurance company. They get to hold on to our money, and while they're holding it, before they have to pay it out for claims, they invest it. They invest that float, billions and billions of dollars, into stocks, bonds, real estate, and other assets. The profits they make from investing this float are staggering. In many years, the investment income is so massive that it can completely offset losses from paying out claims. This is the secret engine of the insurance industry. They can actually lose money on the insurance side of the business, paying out more in claims than they collect in premiums, and still be wildly profitable overall because of their investment returns. So, what does this have to do with your 7-day policy? Everything. The entire model is built on one crucial factor: time. The longer they can hold on to your money before you might need it, the more money they can make by investing it. A 6-month policy gives them a nice, stable, predictable chunk of cash to work with for half a year. A 1-year policy is even better. A customer who stays with them for 20 years is a gold mine. They are predictable. Their money contributes to the float for decades. Now, look at a 7-day policy from their perspective. It's a nightmare. First, the administrative cost. The work involved in running your background check, assessing your risk profile, calculating a premium, processing the payment, and issuing a policy document is almost identical whether the policy is for 7 days or 7 months. It's a fixed cost. On a 6-month policy, they can spread that cost out over 26 weeks. The profit margin is healthy. On a 7-day policy, they have to cram that entire cost, plus their desired profit, into just 1 week. The premium would have to be astronomically high to make it worthwhile, which would price most people out of the market. From a pure processing standpoint, it's an inefficient, low-margin headache. But it gets worse for them. The second and far more critical problem is a concept called adverse selection. It's a fancy term for a very simple idea. The people who most actively seek out a specific type of insurance are often the ones who are most likely to use it. Think about it. Who is the typical customer for a standard 6-month auto policy? It's everyone. It's a soccer mom driving her kids to practice, a commuter heading to the office, a retiree going to the grocery store. It's a huge, diverse pool of people, and the vast majority of them will go the entire policy period without a single claim. Their risk is spread out and predictable on a macro scale. Now, who is the typical customer for 7-day car insurance? It's someone in a non-standard, temporary, and often higher-risk situation. It's the person flying into a different state to buy a specific used car and drive it 1,000 miles back home through unfamiliar territory. It's the friend who's borrowing a powerful pickup truck to move their entire apartment across town in 1 weekend. It's the person whose primary insurance just lapsed, and they need coverage immediately to avoid driving illegally, possibly because they missed a payment. It's the international visitor trying to navigate American roads for the first time. Do you see the pattern? The pool of applicants for short-term insurance is, by its very nature, pre-selected for higher risk. The insurance giants look at this group and their algorithms flash red. They see a pool of drivers who are more likely to be in unfamiliar vehicles, driving on unfamiliar roads, under time pressure, or in a state of financial distress. This is the opposite of the stable, predictable customer they want. Adverse selection means that the claims rate for a block of 7-day policies is likely to be significantly higher than for a block of standard annual policies. So not only is the administrative cost high and the investment float non-existent, but the risk of actually having to pay out a claim is substantially greater. It's a trifecta of unprofitability. Finally, there's the issue of what's called customer lifetime value, or CLV. The big carriers play the long game. They spend billions on those catchy Super Bowl ads not just to sell you a car insurance policy, but to begin a relationship with you. They want to become your trusted provider. Once they have you for auto, they'll try to bundle it with your renter's or homeowner's insurance for a discount. Then they'll offer you life insurance, umbrella policies, maybe even small business insurance. Over a lifetime, a single customer can be worth tens of thousands of dollars to them. The 7-day insurance customer offers none of that. You are, by definition, a transient customer. You need them for a specific one-time task and then you're gone. There's no opportunity to upsell, no chance to bundle, no long-term relationship to cultivate. You are a one-night stand in an industry built on long-term commitment. When you add it all up, the high administrative costs, the lack of investment float, the massive risk from adverse selection, and the zero potential for lifetime value, you can see why the big players don't just avoid this market, they actively run from it. It breaks every rule in their highly optimized trillion-dollar playbook. It's a completely different business model. This created a vacuum, a clear and present need for temporary coverage that the giants refused to fill. And into that vacuum stepped a new breed of insurance provider. These aren't the household names you see on TV. They are often leaner, more technologically agile companies that built their entire business model around the very things the big guys hate. They don't have massive brick-and-mortar offices or huge legions of agents. They operate primarily online. Their underwriting process is heavily automated, using algorithms to approve or deny applications in minutes, not days. This slashes their administrative costs. They accept the reality of adverse selection and simply price their product accordingly. They know the risk is higher, so the premium per day is higher. They aren't trying to compete with Geico on a per-year basis. They're competing with the alternative, which is often having no insurance at all. And they have absolutely no expectation of a long-term relationship. They are built for speed and efficiency, designed to solve one specific problem for a customer, and then move on to the next. They are the specialists, the niche players who thrive in the cracks that the giants are too big and too inflexible to fill. So, the reason you don't see ads for it, the reason you have to go looking for it, is because you're not the customer the big guys want. You're the customer for a different kind of company altogether. Understanding this distinction is the key to navigating the world of short-term insurance. It explains why the process feels different, why the companies are unfamiliar, and why the coverage options are structured in a unique way. Now that we've pulled back the curtain on the industry economics, we can get to the practical questions. Who exactly are these specialist companies? Are they legitimate? And when you actually go to get a quote, what kind of information do you need to have ready? What does the fine print say? And what are the hidden traps you absolutely need to avoid? Let's dive into the nitty-gritty of actually acquiring a policy. Okay, so where do you even start looking? It's not like you can just walk into your local insurance agent's office and see a big sign that says, 7-day policies sold here. The truth is, the industry makes this a little bit of a treasure hunt, but there are 3 main paths you can go down. First, you have the giants, the big household names you see on TV every 5 minutes. Think Progressive, Geico, Allstate. Now, here's the tricky part. Most of them don't officially advertise a 7-day policy. It's just not a big moneymaker for them. What they do offer are standard 6-month or 1-year policies. The strategy here, which some people use, is to buy a full policy and then cancel it after a week. Sounds simple, right? But this path is littered with landmines. We're talking about potential cancellation fees, prorated refunds that might not be what you expect, and the risk of getting a black mark on your insurance record for being a short-term customer, which can make it harder to get insured later. It's a viable option, especially if you need coverage from a very well-known brand, but you have to tread very, very carefully. We'll talk more about those cancellation traps in a bit. The second path, and honestly the more direct route for most people, is through specialized online brokers and agencies. These are the companies that live and breathe non-standard insurance. They act as a middleman, partnering with various underwriters who are willing to write these shorter-term policies. Companies like the Zebra or Insure.com are aggregators that let you compare quotes from different providers at once. This is often the fastest way to see a range of options specifically tailored for temporary use. They understand the need, they've built their online systems for it, and the process is usually much more straightforward. You're not trying to fit a square peg into a round hole like you are with the major carriers. Then there's the third path, a more modern, tech-driven alternative, pay-per-mile insurance. Think of companies like Metromile or Mile Auto. Their entire model is based on charging you a low base rate plus a few cents for every mile you actually drive. If you only need a car for a week and you're not planning a cross-country odyssey, this can be an incredibly cost-effective option. You get a full-featured policy, but you only pay for what you use. The catch? It often requires you to plug a small device into your car's diagnostic port to track the mileage, so there's a bit of a setup process. It's not ideal for borrowing a friend's car for a weekend, but if you've just bought a car and need to bridge the gap for a week, it's a brilliant solution. So you've picked your path. You're on a website ready to get that quote. A form pops up. It's time to provide your information. This is the moment where the insurance company's algorithm starts judging you, and every single box you fill in can make that price swing wildly up or down. First, the easy stuff: your name, date of birth, and address. This is basic identity verification, but your address is the first major pricing factor. Insuring a car in a dense urban area with high traffic and high crime rates is going to cost more than insuring the exact same car in a quiet rural town. They have decades of data on accident and theft claims, broken down by zip code. Next, and this is the big one, your driver's license number. This is the golden key. The second you enter it, their system is running a check on you. They are pulling what's called your motor vehicle record, or MVR. This is your permanent driving report card. Every speeding ticket, every fender bender, every DUI, it's all there. A clean record? You're a star student, and you'll get the best rates. A ticket for going 15 over a couple years ago? The price just ticked up. A recent at-fault accident? The price just jumped significantly. A DUI? You might be denied coverage altogether. They aren't just trusting you when you say you're a good driver. They are verifying it in real time. This is the single most important piece of personal information you will provide. Then comes the vehicle itself. You'll need the make, model, and year. But most importantly, you'll need the VIN, the vehicle identification number. It's a 17-digit code, usually visible on the dashboard through the windshield or on the driver's side door jamb. The VIN is like the car's social security number. It tells the insurer everything. Its exact trim level, engine size, and most importantly, its history. They can see if it's been in a major accident and has a salvage title. The VIN also allows them to assess the car's specific risk profile. A 2018 Honda Civic is a known quantity. It's safe, parts are cheap, and it's not a huge theft magnet. The insurance will be reasonable. A 2018 Porsche 911? It's incredibly fast, astronomically expensive to repair, and a prime target for thieves. The insurance cost will reflect that, and it will be astronomically higher. Every car has a rating based on safety tests, repair costs, and theft statistics, and the VIN is how they look it up. Finally, you'll be asked to choose your coverage levels. This is where you can get lost in jargon, but it's actually pretty simple. Think of it in 3 parts. Part 1 is liability coverage. This is the coverage that is legally required in almost every state. It does not cover you or your car. It covers the other person if you cause an accident. It's broken into 2 pieces: bodily injury, which pays for their medical bills, and property damage, which pays to fix their car or property. You'll see numbers like 25/50/25. That means the policy will pay up to $25,000 for one person's injuries, a maximum of $50,000 for all injuries in a single accident, and up to $25,000 for property damage. Going with the state minimum is the cheapest option, but it's a huge gamble. If you cause a serious accident and total someone's brand new $60,000 truck, your $25,000 minimum coverage is going to run out fast, and you'll be on the hook for the rest. Part 2 is collision coverage. This is the part that pays to fix your car if you get into an accident you caused, like hitting another car or a telephone pole. This is usually optional unless you have a loan on the car. Part 3 is comprehensive coverage. This covers your car for almost everything else: theft, vandalism, a tree branch falling on it, hitting a deer, hail damage, fire. It's the acts of God and chaos coverage. For a 7-day policy, most people stick with liability to keep it cheap. But if you're driving a valuable car, even for a week, skipping collision and comprehensive is like walking a tightrope without a net. Now you've submitted all this info. You're about to click buy. Stop. This is where you need to put on your detective hat and read the fine print, because the traps are hidden here. First, that cancellation fee we mentioned. If you went with a major carrier for a 6-month policy, look for the term short rate cancellation. This is a penalty they charge for not keeping the policy for its full term. It can be a flat fee or a percentage of your remaining premium, and it can easily wipe out the refund you were expecting. You might pay for a week but end up being charged for a full month. Second, check the policy's effective date and time. You click purchase at 3 p.m. on a Friday, assuming you're covered to drive off the lot. But some policies, especially from less-known online insurers, might have a waiting period. They might not become active until 12:01 a.m. the next day. Driving that car for those 9 hours could be a life-altering mistake because you would be completely uninsured. Third, look for usage restrictions. A standard temporary policy is for personal use only. That means driving to the store, visiting family, a road trip. It does not cover you if you decide to make a few bucks delivering for DoorDash or driving for Uber. That's commercial use, and it requires a completely different, more expensive type of insurance. If you get in an accident while doing gig work, your personal policy will deny the claim, and you'll be in a world of financial hurt. Finally, are there any geographic limitations? Most policies in the US will cover you in all 50 states and Canada. But driving into Mexico? That's almost always excluded. You'll need a separate, specialized policy for that. Don't just assume your coverage follows you everywhere. Navigating this process is a minefield, but by knowing where to look and what questions to ask, you can find the right policy without getting ripped off or worse, finding out you're not covered when you need it most. So you've navigated the application, you've dodged the fine print traps, and you have a quote sitting in front of you. It's a number on a screen, but what does it mean? Is it a fair price? What's a good deal? What's a total ripoff? And what are the secret factors that can slash that price in half before you click buy? In the next part, we're going to break down the mysterious world of short-term insurance pricing, and I'll show you how to make sure you're paying the absolute lowest price possible for the coverage you need. So let's pull back the curtain on this so-called mystery. Getting a price for 7-day car insurance isn't like buying a gallon of milk where the price is on the sticker. It's more like buying an airline ticket. The price you pay can be wildly different from the person sitting right next to you, even if you're both going to the same place. Why? Because the price isn't just a number. It's the output of a complex algorithm, a digital brain that weighs dozens of factors about you, your car, and your trip to calculate one single thing: risk. The higher your perceived risk, the higher your price. It's that simple. Our job isn't to try and trick the algorithm. Our job is to understand it. We need to know which buttons it's pushing, which levers it's pulling, so we can present ourselves in the least risky, and therefore least expensive way possible. Think of it like a credit score. There are things that are baked in, and there are things you can actively manage to improve your number. Let's start with the big ones, the factors you generally can't change in the short term, but you absolutely need to be aware of because they form the foundation of your price. First, and this might seem unfair, is your age and, in many states, your gender. Statistically, drivers under the age of 25 are involved in more accidents. It's a blunt instrument for sure, but to an insurance algorithm, a 21-year-old male represents a higher risk than a 45-year-old female, and the initial price will reflect that. There's nothing you can do about your age, but knowing this sets the stage. If you're a young driver, it becomes even more critical to optimize the factors you can control. Second, and this is the heavyweight champion of pricing factors, your driving record. This is the algorithm's window into your past behavior. A recent at-fault accident? That's a major red flag. A speeding ticket for going 20 over? That's another one. A DUI? That's the nuclear option. It can make you almost uninsurable for temporary coverage, and if you can find it, the price will be astronomical. On the flip side, a clean record for the past 3 to 5 years is like gold. It tells the insurer you are a responsible, low-risk client, and they will fight for your business with a lower price. Third is your location. Specifically, the zip code where the car will be garaged, or primarily kept during the policy period, even if it's just your home address for a road trip. Insurers have decades of data on every single zip code in the country. They know the rates of accidents, vehicle theft, vandalism, and even weather-related claims like hail damage for your specific neighborhood. That's why a 7-day policy for the exact same driver and car could cost 30% more in Brooklyn, New York, than it does in rural Boise, Idaho. More cars, more traffic, more congestion, more theft, equals more risk and a higher premium. And fourth is the car itself. You can't exactly swap your car out for a week, so we'll file this under unchangeable. Insuring a brand new Ford F-150 Raptor is going to cost a heck of a lot more than insuring a 12-year-old Toyota Camry. The algorithm looks at the vehicle's value, the cost to repair it, its safety ratings, and even its theft rate. Performance cars and luxury SUVs have expensive parts and are bigger targets for thieves. A boring, reliable sedan? It's cheap to fix and blends in. The algorithm loves boring. Okay, so that's the stuff that's mostly set in stone. It can feel a little discouraging, right? But don't worry. Those factors just set your baseline price. Now we get to the fun part. These are the levers you can pull, the dials you can turn to actively slash that baseline price, often by 50% or more. This is where you take control. The single most powerful lever you have is your coverage level. This is the big one. When you buy insurance, you're not just buying a single product. You're choosing from a menu. At the bottom of the menu is liability only. This is the bare minimum required by the state to legally drive. It covers damages you cause to other people and their property. It does absolutely nothing for you or your car if you cause an accident. Think of it as the insurance that keeps you out of jail, not out of the repair shop. At the top of the menu is full coverage. This is a combination of liability, plus two other key coverages, collision and comprehensive. Collision pays to repair your car if you hit something, whether it's another car or a telephone pole. Comprehensive pays for almost everything else. Theft, vandalism, a rock cracking your windshield, a tree falling on your car, hitting a deer. Here's the secret. For a 7-day policy, you need to ask yourself a very honest question. Do I really need full coverage? If you're borrowing your brother's brand new $60,000 SUV, then yes, you absolutely do. But if you're driving a 2010 Honda Civic that's worth maybe $4,000, paying an extra $70 for a week of collision and comprehensive might not make sense. If you got in an accident, you could probably cover the repairs or the loss of the car out of pocket for less than the long-term cost of the claim. Simply switching from full coverage to liability only can cut your premium in half instantly. The second lever is your deductible. This is only for those who choose full coverage, but it's a critical dial to turn. A deductible is simply the amount of money you agree to pay out of pocket for a repair before the insurance company pays a dime. Let's say you have a $500 deductible, and you get into an accident that causes $3,000 in damage to your car. You pay the first $500, and the insurance company pays the remaining $2,500. Insurers offer different deductible levels, usually from $250 all the way up to $2,000. And here's the relationship you need to remember. The higher your deductible, the lower your premium. By choosing a higher deductible, you're telling the insurance company, I'm willing to take on a little more of the initial risk myself. The algorithm sees this as you being a more responsible partner in the deal, so it rewards you with a lower price. Just by moving your deductible from $500 to $1,000, you could easily save $10 to $20 on a 7-day policy. The golden rule is to pick the highest deductible you could comfortably pay tomorrow, in cash, without causing a financial crisis. So how do we put this all together into a practical money-saving strategy? Let's call it the 3-step price crusher method. Step 1 is the quote gauntlet. Never ever ever accept the first price you're given. Short-term insurance is a competitive market. You need to run the gauntlet and get quotes from at least 3 to 5 different companies. Go to the websites of major providers that offer temporary policies. Use a couple of the big online comparison tools that check multiple insurers at once. This process alone can reveal massive price differences for the exact same coverage. You're making the companies compete for your money. Don't let them think you're a captive audience. Step 2 is the coverage scalpel. Once you have a few quotes, take the best one and apply the scalpel. Start with the full coverage option to see the maximum price. Then ask yourself that honest question about the car's value. If it's an older, paid-off vehicle, get a new quote for liability only. Watch the price plummet. This is about matching the coverage to the reality of your situation, not just clicking the default, recommended option. Step 3 is the deductible dial. If you've decided you do need full coverage, now it's time to fine-tune. Go back to your best quote and play with the deductible. Most sites have a little slider or a drop-down menu. See what happens to the price when you move the deductible from $500 to $1,000. Then see what happens when you move it to $1,500. Find that sweet spot where the savings are meaningful, but the deductible is still an amount you can stomach. By running this simple 3-step process, you are systematically dismantling the insurer's pricing structure and rebuilding it in your favor. You're not just a passive customer. You're an active, informed shopper. By now, you should be feeling empowered. You know what they look at and you know what you can change. You can run the price crusher method and find a policy that seems unbelievably cheap. But this is where a new danger emerges. You've found a 7-day policy for what seems like pennies a day. Feels like you've won. But what if that cheap policy is a trap? What if it's filled with loopholes and exclusions designed to ensure the company never has to pay a claim? It seems too good to be true, and it very well might be. In the next part, we are going to dive into the treacherous waters of the policy fine print. I'll show you the exact gotcha clauses, the hidden exclusions, and the red flags that can turn your bargain insurance into a worthless piece of paper when you need it most. Alright, grab a magnifying glass because we're going in. The first and most common trap, the one that snares thousands of people, is called the named driver exclusion. It sounds boring, but I promise you, this little phrase is a financial landmine. You see, with your standard long-term insurance policy, you usually have something called permissive use. It means if you let your responsible friend, your brother, your girlfriend borrow your car to run to the store, they're covered. Your insurance follows the car. It's a safety net we all take for granted. But with many 7-day policies, that safety net is gone. It's been ripped out. The policy only covers the person whose name is typed on that single line. The named insured. Period. No one else. Imagine this, you buy a car on a Saturday. You get a 7-day policy to drive it home and sort out your annual insurance during the week. On Sunday, your wife says, "Hey, can I take the new car to the grocery store? I want to see how it feels." You say, "Of course, honey." It seems like the most normal, innocent thing in the world. On her way back, someone runs a stop sign and T-bones her. It's not her fault, but the car is totaled. You call the 7-day insurance company, heart-pounding, and say, "My wife was in an accident." And the agent on the other end of the line says, "I'm sorry, who was driving?" You tell them. There's a pause. And then they deliver the knockout blow. Your policy only covers you. The claim is denied. In that one moment, you've lost the entire value of your new car. You are on the hook for every single dollar. That's the named driver exclusion. Look for phrases in the policy documents like "coverage applies only to the named insured" or "permissive use is expressly excluded." If you see that, understand that you, and only you, can be behind the wheel. Not for a minute. Not to move it across the driveway. Only you. Next up is the silent killer of the road trip. The mileage limitation. You buy a policy for 7 days. You assume that means you can drive as much as you want for 7 days, right? Wrong. Buried deep in the terms and conditions, many of these ultra-cheap policies have a strict mileage cap. It might be 500 miles. It might be 750. They don't advertise this on the homepage. They don't put it in the big, friendly font. It's tucked away, waiting to ambush you. Let's say you buy a car in Phoenix and you plan to drive it back home to Denver. That's about 800 miles. You get a 7-day policy, thinking it's perfect for the trip. You don't notice the 750-mile limit in the fine print. You're on the last leg of your journey, just 30 miles from your house, and a deer jumps out in front of you. A major front-end collision. You file the claim. The first thing the insurance adjuster asks for is the odometer reading at the time of purchase and the odometer reading from the tow yard. They do the math. 812 miles. "I'm sorry," they say. Your policy was void the moment you crossed the 750-mile limit. You were driving uninsured for the last 62 miles. Every penny of the repair, every dollar of the medical bills if someone was hurt, is now your personal debt. The few bucks you saved on the policy just cost you $20,000. Always look for a section called Usage Restrictions or Policy Limitations and find out if there is a mileage cap. If there is, you need to treat it like a ticking time bomb. The third gotcha clause is the geographic restriction, and this one is especially deceptive. You buy a policy in the United States, you assume it covers you in the United States. But many of these temporary insurers are only licensed to operate in specific states. Your policy might be a California-only policy or a Texas-only policy. This is incredibly dangerous for anyone living near a state border. Think about someone living in Kansas City. They might live in Missouri but work in Kansas. They pop back and forth across the state line multiple times a day without even thinking about it. They buy a 7-day policy to cover a new car, and the policy is issued by a company only licensed in Missouri. The second their tires touch Kansas pavement, their insurance evaporates. It's null and void. They could get in a fender bender at their office parking lot in Kansas, and as far as their insurance is concerned, it might as well have happened on the moon. The coverage is gone. Before you buy, you must find the territorial limits or coverage area section. It will explicitly state which states the policy is valid in. If it only lists one state, and you have even the slightest chance of crossing a state line, that policy is a trap waiting to be sprung. Now for the one that trips up everyone in the modern gig economy. The business use exclusion. This is a big one. These short-term policies are almost universally written for personal and pleasure use only. What does that mean? It means driving to a friend's house, going to the movies, getting groceries. Commuting to your regular 9-to-5 job is usually fine. But the second you use the vehicle to make money, you're in hot water. And it doesn't have to be a full-time job. Let's say you're between jobs, and to make a few extra bucks, you decide to turn on the DoorDash app for an hour. You pick up an order, and on the way to the customer's house, you get into an accident. When you file the claim, the adjuster will ask what you were doing. If you tell the truth, and you must because lying is insurance fraud, they will deny your claim instantly. This was commercial use, which is excluded from your policy. The same goes for an independent contractor driving to a client site, a real estate agent driving to show a house, or even a photographer driving to a paid gig. If the purpose of that specific trip is to earn income, your personal 7-day policy is likely worthless. You need to hunt for phrases like commercial use prohibited, no livery or delivery, or for personal use only. In today's economy, this exclusion is a minefield that can blow up your financial life over a single pizza delivery. Finally, there's a sneaky one that people rarely think about, the vehicle modification clause. When you get a quote, the insurance company is basing the price on a stock vehicle, just as it came from the factory. But the used car you just bought might not be stock. The previous owner might have added custom wheels, a modified exhaust, an aftermarket turbo, or even just a fancy stereo system. If you don't declare these modifications, even if you didn't make them yourself, the insurer can use it against you. Let's say you get into an accident. The claims investigator goes to the body shop and sees the car has a high-performance engine air intake that wasn't on the original application. They can argue that you misrepresented the vehicle. They can say, "We insured a standard Honda Civic, but this is a modified, higher-risk vehicle. You failed to disclose this, which is a breach of contract." And just like that, claim denied. It feels unfair, especially if the modification had nothing to do with the accident, but it's a loophole they can and will use. When you apply, you have to be brutally honest about the state of the car. If it has custom parts, you have to declare them, even if it makes the premium a little higher. A slightly more expensive policy that actually pays out is infinitely better than a cheap one that's just an illusion of security. These 5 clauses, named driver, mileage limits, geographic restrictions, business use, and vehicle modifications, are the biggest sharks in the water. They are the fine print details that allow companies to sell a policy for a rock-bottom price, knowing that a significant percentage of claims can be legally denied. But navigating this minefield is only half the battle. So you've read the fine print, you've avoided the traps. You're safe, right? Not exactly, because now we have to talk about the claims process itself. And this is where the nightmare truly begins for many people. What happens when you actually have an accident on a 7-day policy? The answer is shocking, and it's what we're exposing next. Imagine the scene. It's Tuesday, day 4 of your 7-day policy. You're driving to a job interview, a dealership, maybe just across town to help a friend move. You're doing everything right. Hands at 10 and 2. You're following the speed limit. Then out of nowhere, a car runs a red light. That sickening crunch of metal, the jolt, the smell of burnt plastic and deployed airbags. Your heart is pounding in your ears, but after the initial shock, a wave of relief washes over you. You're okay, and you have insurance. You pull out your phone, look at that digital proof of coverage, and you think, "Thank God I bought that policy." You make the call. The person on the other end is calm, professional. They take your details, the other driver's information, the police report number. It all feels normal, just like you'd expect from any major insurance carrier. They tell you an adjuster will be in touch. You hang up, shaken but confident that the system is working. You did the responsible thing. You're covered. But what you don't know is that the moment you said the words, "I bought the policy 4 days ago," a switch was flipped. Your claim file wasn't just opened, it was flagged. It wasn't sent to a standard adjuster. It was immediately routed to a specialized division. At some companies, it's called the Special Investigations Unit, or SIU. Their job isn't to process your claim. Their job is to find a reason to deny it. For a standard insurance company, a claim from a long-term customer is business as usual. For a 7-day insurance provider, a claim is a catastrophic loss. Their entire business model is built on collecting small premiums from people who won't have an accident. When you do, you're not a customer to be helped. You're a 5-figure liability that needs to be neutralized. So the investigation begins. And it is nothing like you imagine. The first thing they attack is the timeline. The adjuster who calls you back isn't asking, "How are you feeling?" They're asking, "What time exactly did the accident occur?" Down to the minute. Then they'll ask, And what time exactly did you purchase our policy? They already have the digital timestamp from your purchase. They have the time on the police report. They are looking for any discrepancy. Their primary, number one suspicion is that you got into an accident first and then frantically bought the policy on your phone from the side of the road. It's called claims after loss. And it's the holy grail of denials for them. If they can prove it, it's not just a denial. It's insurance fraud, and they can threaten you with legal action. Let's say your timeline is perfect. You bought it Monday at 9 a.m. The accident was Tuesday at 3 p.m. You think you're in the clear, but they're just getting started. The next phase of the investigation targets you. They'll ask for a recorded statement. This is not a friendly chat. It is a deposition where you have no lawyer. Every question is a potential trap, designed to find a contradiction between your answers and the information you provided when you bought the policy. Remember that quick online form you filled out in 2 minutes? Every single answer you gave is now under a microscope. They'll ask, "So where were you driving to?" You say, "A job interview." The investigator makes a note. They go back to your application. You check the box for pleasure use, because you weren't planning on commuting to a regular job. Now they have a potential material misrepresentation. You were using the vehicle for business purposes, not pleasure. It sounds insane, it sounds trivial, but they will use it to argue that you misrepresented the risk and therefore your policy is void. They'll ask about your living situation. "So, you live with your brother? Does he ever drive the car?" You say, "No, never." But they might pull a background report and see his name is also listed at your address. Now they can argue you failed to list another licensed driver in the household. Another material misrepresentation. They'll ask who owns the car. If it's not in your name, they will dig into the concept of insurable interest. Did you really have a financial stake in this vehicle? Or were you just trying to get a policy for a friend? If they can create any doubt, they can deny the claim. This isn't about the accident anymore. They don't care who ran the red light. They are building a case against you. They are looking for any thread, any tiny inconsistency, to pull on until your entire policy unravels. While this is happening, your car is probably sitting in a tow yard, racking up storage fees day after day. The 7-day insurance company will not pay for these fees while they investigate. That's on you. The other driver's insurance company is calling you, demanding a statement, wanting your company to pay for their client's damages. You tell them your insurance is investigating, and you can hear the audible sigh on the other end of the line. They've heard this story before. They know what's coming. After weeks of silence, after you've left a dozen voicemails that go unreturned, the letter arrives. It's thick, formal, and filled with legal jargon. It won't say, "We think you lied." It will say something clinical like, "Upon review, it was determined that there was a material misrepresentation on your application regarding the vehicle's primary usage. As a result, we are exercising our right to rescind the policy, effective from its inception date. Your claim is denied." And just like that, it's over. The premium you paid? Maybe you'll get it back, maybe not. The insurance you thought you had? It has been retroactively erased. It's as if it never existed. You are now an uninsured driver who was involved in an accident. You are personally on the hook for all of your own repairs. You're on the hook for the tow yard fees. And worst of all, you are now personally liable for the damages to the other car, the other person's medical bills, their lost wages. The lawsuit that follows can financially ruin you for the next decade. You did what you thought was the right thing. You bought insurance. But you didn't buy a shield, you bought a target. You paid a small fee to a company that, in the moment of truth, deployed a team of specialists whose sole purpose was to prove you were unworthy of the coverage you purchased. They took your money, and when you needed them most, they pointed to the fine print, turned their back and walked away, leaving you alone in the wreckage. This is the brutal reality of the claims process for so many people with these policies. It's a system designed to accept premiums and deny claims. But there's another side to this nightmare. What happens if you're the responsible driver with a great standard insurance policy, and you get hit by someone with 7-day coverage? You might think, well, my insurance will handle it. But you have no idea the labyrinth of pain you're about to enter. The problem isn't just that their insurance won't pay them. The real terrifying secret is what it means for you. Because when that 7-day policy expires, and that driver T-bones you at an intersection on day 8, they are, for all intents and purposes, uninsured. They have no coverage. Zero. And the person who hit you, the one who was only willing or able to pay for 7 days of insurance, is almost certainly not sitting on a pile of cash to pay for your $20,000 car and your $50,000 medical bills. They are what the legal system calls judgment-proof. You can sue them, you can win, you can get a piece of paper from a judge saying they owe you $70,000, and it's worth less than the paper it's printed on. You can't get blood from a stone, and you can't get money from someone who doesn't have it. So the other driver is a financial black hole. Their insurance company, which collected a small premium for a week of coverage, is long gone. They fulfilled their contract. It expired. They owe you nothing. Who's left? You. This is where the real nightmare begins. You call your own insurance company, the one you've been faithfully paying hundreds of dollars to every single month for years. You say, "Hey, I was hit by an uninsured driver. I did nothing wrong. Please help me." And this is the moment you discover the most important and least understood part of your own policy: uninsured and underinsured motorist coverage. Or more terrifyingly, your lack of it. Let's walk through this labyrinth. Scenario 1. You don't have uninsured motorist, or UM coverage. Maybe you waived it to save a few bucks a month. Maybe your state doesn't require it and you never thought to add it. In this case, your insurance company will likely tell you some version of this: "We are so sorry this happened to you. However, you were hit by another driver. Your collision coverage will pay to fix your car, but you'll have to pay your deductible, which could be $500, $1,000, even $2,000. Think about that. You were sitting at a red light obeying every law, and now you are out $1,000 instantly through no fault of your own. And what about your medical bills? Your lost wages from being unable to work? Your pain and suffering? Your insurance company will say, "That's not what collision coverage is for. You'll have to sue the other driver for that." And we've already established that's a dead end. So you are left holding the bag. Your car is in the shop, you've paid a hefty deductible, your medical bills are piling up, and the person responsible has vanished into the ether, leaving you with the financial wreckage. Your rates might even go up after the claim, adding insult to injury. That is the stark, brutal reality for millions of Americans who get hit by uninsured drivers every year. And these 7-day policies are pouring gasoline on that fire, creating a revolving door of drivers who are insured one week and uninsured the next, playing a game of Russian roulette on the highway with your financial future. Now let's look at scenario 2. You're a responsible person. You listen to the advice. You have uninsured motorist coverage. You breathe a sigh of relief. You think you're safe. But you're not out of the woods. You're just in a different, more complicated part of the forest. When you make a UM claim, you are not filing against the other driver. You are filing a claim against your own insurance company. Let me repeat that because it's critical. You are now in an adversarial relationship with the same company you paid to protect you. Their goal, like any business, is to minimize their payout. Your goal is to be made whole. These two goals are now in direct opposition. Suddenly, the friendly agent on the phone becomes a skeptical claims adjuster. They will investigate the accident as if you're a suspect. They'll want recorded statements. They'll scrutinize your medical records. They'll question the severity of your injuries. They'll argue about the value of your totaled car. Every dollar they pay you for your medical bills, your lost wages, your pain and suffering, comes directly out of their pocket. You, their loyal customer, have become their financial adversary. And here's the kicker. Your coverage has limits. Most people just get the state-mandated minimums. In some states, the minimum UM bodily injury liability is as low as $25,000. That might sound like a lot of money, but one ambulance ride, an emergency room visit, and a few x-rays can eat up half of that before you even see a specialist. What if you need surgery? What if you need months of physical therapy? That $25,000 will be gone in a flash, and you're right back to where you started, with a mountain of bills and no one to pay them. Even if you have higher limits, say $100,000, the fight to get that money can be a grueling, soul-crushing war of attrition. The insurance company might offer you a quick, lowball settlement of $10,000 or $15,000, hoping you're desperate enough to take it and go away. They know that if you refuse, you'll have to hire an attorney. That means months or even years of depositions, legal filings, and stress, all while you're trying to recover from your injuries. And if you do win, your attorney will take a third of the settlement. This is the labyrinth. It's a system that seems designed to punish the victim. You did everything right. You bought the right coverage. You drove safely. And yet, you're the one paying a deductible, fighting with your own insurance company, and potentially drowning in debt, all because the person who hit you exploited a loophole with a 7-day policy, A policy that allows them to present a valid insurance card on day 1 and be a complete menace to society on day 8. This isn't some rare freak occurrence. The Insurance Research Council estimates that 1 in 8 drivers in America is uninsured. That's over 32 million people. And in some states like Mississippi and Florida, it's closer to 1 in 4. These 7-day policies are a significant contributor to this problem, creating a constant churn of drivers who are technically insured just long enough to get their car off the lot or their registration renewed, before lapsing back into uninsured status. They are ticking time bombs on our roads, and you have no way of knowing if the car next to you is one of them. You can be the safest driver in the world, but it doesn't matter. Your financial health is completely at the mercy of the least responsible person you share the road with. The problem isn't just about the financial fallout, though. It's about the fundamental unfairness of it all. The person who caused the accident walks away with virtually no consequences, while you, the innocent victim, are left to navigate a hostile and unforgiving system. It's a system that allows a driver to pay $100 for a piece of paper that gives them a temporary license to cause potentially hundreds of thousands of dollars in damage, and then simply disappear, leaving their victims to fight with their own insurance companies for scraps. So when we talk about the dangers of 7-day insurance, this is the secret that nobody tells you. It's not just about the person who buys it. It's about the ripple effect of financial devastation they can cause to everyone around them. It's a crack in the foundation of the auto insurance system, and it's getting wider every single day. But the drivers and the victims aren't the only ones caught in this mess. There's another group, a powerful industry that quietly profits from this chaos, all while making the roads more dangerous for every single one of us. This powerful industry isn't Geico, Progressive, or State Farm. You won't see their multi-million-dollar Super Bowl commercials. They don't have friendly mascots or catchy jingles. This is a shadow industry, a network of smaller, often obscure agencies and brokers that have perfected a single incredibly profitable business model, selling the illusion of security. Their real product isn't insurance. It's a piece of paper. It's a temporary proof of insurance card, a digital file you can show a police officer on your phone, a binder that satisfies the clerk at the DMV. They are not in the business of protection. They are in the business of compliance. They sell a short-term solution to a long-term legal requirement, and they have built a multi-million-dollar empire on that single premise. To understand how this works, you have to throw out everything you think you know about traditional car insurance. A company like Allstate or Liberty Mutual has a business model built on longevity. They want you as a customer for 5, 10, 20 years. They analyze risk, yes, but their goal is to collect your premiums over a long period, invest that money, and hopefully pay out less in claims than they take in. Their ideal customer is a safe driver who pays their bill on time, every time for decades. They call this customer retention. The 7-day insurance industry operates on the exact opposite principle. Their ideal customer is someone who pays for 1 week and then disappears forever. They don't want retention. They thrive on churn. Their entire financial structure is a house of cards built on the assumption that the vast majority of their customers will let the policy lapse. Think of it this way. For a standard insurer, a claim is a predictable cost of doing business. For a 7-day insurer, a single significant claim can be catastrophic. If a customer pays them, say, $50 for a week of coverage and then gets into an accident causing $10,000 in damage, that single event could wipe out the profit from 200 other customers. Their profit margins are so razor-thin, their risk pool so volatile, that they simply cannot afford to pay claims. So, how do you build a business where you sell insurance but desperately want to avoid ever paying for an accident? You do 2 things. First, you create a product that is designed to be temporary. And second, you market that product specifically to people who are most likely to only need it temporarily. This isn't just a business strategy. It's a form of financial predation, and it's happening in plain sight. Let's look at the marketing. These companies are masters of targeting vulnerable populations. Their physical offices are rarely found in affluent suburbs. Instead, they cluster in low-income neighborhoods, often setting up shop right next to used car dealerships that specialize in subprime auto loans, or directly across the street from the DMV. This is not a coincidence. They are placing their nets exactly where the fish are swimming. They target people who are unbanked, who have poor credit, or who have a checkered driving history, the very people who are turned away by mainstream insurers or quoted astronomically high rates. Their advertising is just as calculated. You'll see their flyers tacked up on community bulletin boards. You'll hear their ads on local non-English radio stations. They run hyper-targeted digital ads using keywords like cheap instant insurance, no credit check car insurance, or get legal today. The messaging is always the same. Fast, easy, and cheap. It promises to solve an immediate, stressful problem, the need to legally drive a car off a lot, or the need to renew a registration to avoid a fine. The promise is not, we will protect your family's financial future. The promise is, we will get the government off your back for a few days. They've created a system that preys on desperation. Imagine you've just spent your last $2,000 on a down payment for a used car. You need to get to your new job. The dealer says you can't drive it off the lot without proof of insurance. You call a major carrier, and they quote you a $400 down payment and $200 a month. You don't have it, but the dealer says, hey, there's a place next door that can get you insured for $50 right now. For someone in that position, it feels like a lifeline, feels like a solution, but it's a trap, because the second part of their strategy is even more insidious. The business model only works if the policies lapse. A lapse policy is pure profit. The company collects the initial premium, bears the risk for exactly 7 days, and then is off the hook. The customer who was sold a quick fix often doesn't realize or can't afford to continue the policy. Maybe they intended to shop for a better rate later and forgot. Maybe their next paycheck was short. The reason doesn't matter to the company. All that matters is that the policy expires. This creates a perverse incentive. These companies are financially motivated to make the renewal process difficult. They are incentivized to have poor customer service. They are incentivized to sell a product that people will abandon. Every driver who pays for a week and then drives uninsured for the next 51 weeks is a success story for their bottom line. And when a claim does happen, the stories are nightmarish. Policyholders report endless phone trees, unreturned calls, and requests for mountains of obscure paperwork designed to frustrate them into giving up. They will scrutinize the initial application, looking for any tiny discrepancy, any box unchecked or detail misstated, that they can use to declare the policy void from the start, a tactic known as post-claim underwriting. They sold you a policy, took your money, but only after you have an accident do they really decide if you were ever truly eligible for it in the first place. It's a classic heads I win, tails you lose scenario. So why is this allowed? How can an industry operate in a way that seems so fundamentally opposed to the very concept of insurance? The answer lies in a patchwork of state-level regulations that are often outdated and ill-equipped to handle this modern high-churn model. Insurance is regulated state by state, not federally. This creates 50 different sets of rules, and these companies are experts at finding and exploiting the loopholes in each one. In some states, the laws governing short-term policies are vague. In others, enforcement is lax due to underfunded departments of insurance. These companies often operate as brokers or managing general agents, adding layers of complexity that shield the ultimate underwriters from scrutiny. They can change their company name, set up a new LLC, and reappear on the same street corner, running the same playbook. For regulators, it's a frustrating game of whack-a-mole against an industry that is nimble, adaptable, and highly motivated by profit. They operate in a legal and ethical gray zone. They aren't technically selling a fraudulent product. They are selling a very limited, temporary insurance policy. But they are selling it in a way that creates a massive, dangerous gap in coverage for the most vulnerable drivers on the road. They are profiting from a system that knowingly puts millions of uninsured drivers onto America's highways. The true cost of that $50 piece of paper isn't measured in the money the driver loses, but in the devastating uncovered accidents that inevitably follow. It's a cost borne by all of us, in the form of higher premiums for our own insurance and, tragically, in the lives and livelihoods shattered by accidents with no financial recourse. This entire system is a ticking time bomb, and it's been allowed to tick for far too long. The real question is, what can be done to stop it? And how can you, as a driver, navigate this minefield and truly protect yourself? The answer is twofold. It requires a massive coordinated effort to fix the system, and a personal immediate strategy to armor yourself against its failures. Let's start with the big picture. Fixing this broken system isn't about one simple law. It's about a complete overhaul of the verification process. The technology exists right now to create a national, real-time insurance database. Imagine a world where every police officer, every DMV clerk, can scan a license plate or a driver's license and instantly see if that vehicle is covered by a valid, active insurance policy. Not a piece of paper that could be forged or from a policy that lapsed 6 days ago, but a live digital confirmation. This single step would render fraudulent 7-day policies instantly obsolete. The moment the policy expires, the system flags the car as uninsured. It's not science fiction. It's a data problem, and it's a solvable one. But technology is only half the battle. We need teeth. We need aggressive, federal-level crackdowns on the ghost brokers and the predatory agencies that profit from this chaos. These aren't just slick salesmen bending the rules. They are orchestrating a massive, multi-million-dollar fraud that leaves victims in its wake. This needs to be treated with the same severity as organized crime. We're talking about wire fraud, racketeering charges, and asset forfeiture. Seize their cars, their houses, their bank accounts. Make the penalty so severe that it's no longer a profitable venture. The message has to be clear. If you sell fake hope on our highways, you will lose everything. And what about the major insurance carriers themselves? They are not innocent bystanders. For too long, they've benefited from a system that allows them to collect premiums on these ultra-short-term policies, while facing a statistically low chance of ever paying out a major claim. They have a corporate responsibility to help close these loopholes. They need to invest in better real-time data sharing with law enforcement and DMVs. They need to stop offering products that are so easily and obviously exploited. And perhaps they need to step up and offer legitimate, flexible insurance options for people who genuinely need short-term coverage, wresting the market away from the predators. But let's be honest, systemic change is slow. It's a battleship turning in a bathtub. While we fight for that better future, you are driving on these roads today, this afternoon, tomorrow morning. You are sharing the asphalt with drivers who are ticking financial time bombs. So the most critical question is, what can you do right now to build a fortress around your financial life? The answer is surprisingly simple. Yet it is the single most overlooked and misunderstood part of every car insurance policy in America. It's two acronyms, UM and UIM, uninsured motorist and underinsured motorist coverage. This isn't an optional luxury. This isn't an upsell. In the world we live in, this is a non-negotiable necessity. It is your personal shield against the failures of the entire system. Here's how it works. If you are hit by a driver who has no insurance, or one of these worthless 7-day policies that has already expired, your uninsured motorist coverage kicks in. It becomes the insurance that the other driver should have had. It pays for your medical bills, your lost wages, your pain and suffering, up to the limits you selected. It saves you from financial ruin. Similarly, if you're hit by a driver who has insurance, but only the bare minimum state-required liability, say $25,000, and your medical bills are $100,000, your underinsured motorist coverage steps in to cover the difference. Think of it this way, your liability coverage protects everyone else from you. Your uninsured and underinsured motorist coverage protects you from everyone else. You control it. You set the limits. You are creating your own safety net because you cannot trust that the other driver has one. I want you to do something. Not later, not next week. Right now. Pause this video if you have to. Pull up your car insurance policy on your phone or computer. Look for the declarations page. Find the line item that says, uninsured/underinsured motorist bodily injury. What does it say? Many people, in an effort to save a few dollars a month, either reject this coverage entirely or have the absolute lowest limits possible. They are, without knowing it, one accident away from bankruptcy. Look at your limits. If your UM/UIM limits are, say, $50,000, that means if an uninsured driver puts you in the hospital, your own insurance company will cover up to $50,000 of your damages. That might sound like a lot, but a single surgery or a few days in the ICU can obliterate that in an instant. The golden rule is that your UM/UIM limits should be, at a minimum, equal to your own bodily injury liability limits. If you have $250,000 in liability to protect others, you should have at least $250,000 in UM/UIM to protect yourself. The cost to increase this coverage is often shockingly small, sometimes just a few dollars a month, but the protection it offers is colossal. And here's a pro tip that your agent might not have even told you about. Ask if your policy has stacked coverage. In many states, if you have multiple cars on your policy, stacked coverage allows you to combine the UM/UIM limits for each car. So if you have 2 cars, each with $100,000 in UM coverage, a stacked policy could give you $200,000 in total protection if you're in an accident. It's a force multiplier for your financial security. This coverage, this personal shield, is your primary defense. But it works best as part of a complete strategy. Make sure you also have adequate collision coverage to fix or replace your car, no matter who is at fault. And consider medical payments coverage or MedPay. which can help pay for your initial medical bills immediately after an accident, regardless of fault, while the larger claim is being processed. Finally, how do you avoid buying one of these sham policies in the first place? Use this simple checklist. 1. Only buy from a licensed agent you can verify or directly from the insurance carrier's official website. If it's a random page on social media or a guy on Craigslist, run. 2. Never ever pay for insurance with cash, a gift card, a wire transfer, or a peer-to-peer payment app. Use a credit card. It provides a paper trail and fraud protection. 3. Demand to see the full policy documents and declarations page before you hand over a single dollar. A legitimate provider will have no problem with this. 4. After you buy, call the insurance carrier's main 1-800 number, the one on their official website, not the one the agent gave you, and verify the policy number and its status. Confirm that it is a standard 6-month or 1-year policy, not a temporary one. The world of 7-day insurance is a dark and dangerous corner of the American auto landscape. It's a story of desperation meeting deception, a system that has allowed predators to flourish and has left countless victims stranded on the side of the road, holding a worthless piece of paper and a mountain of debt. But knowledge is power. You now know how the scam works. You know the red flags to look for. And most importantly, you know how to build your own impenetrable financial fortress. Don't wait to become a statistic. Don't wait until you see the headlights coming and have to wonder if the person behind the wheel made a responsible choice. Make the responsible choice for yourself right now. Review your policy. Call your agent. Increase your uninsured motorist coverage. It is the single best investment you can make in your peace of mind on the road. The highway is filled with uncertainty, with risks you can't control. But the strength of your own safety net? That is entirely in your hands. Drive safe, drive smart, and drive protected.